Welcome back to the Consulting Mind. Today we're going to continue to talk about the rising 10-year bond yield. But this time, we're going to explore it in a different perspective. We're going to focus more about how inflation is being factored in the rising 10-year bond yield. So now, let's do a very quick recap on the last episode takeaway. The first one is that the rising 10-year bond yield is the result of the change in inflation among the market. And the second one is that there is a concern and fear from the market that the QE policy may be pulled back earlier than have been expected. And then we can look at the latest data of the 10-year Treasury yield. We can see that it had been rising from 0.9% in early January, and then it has been hovering around 1.5% in late February to early March, and eventually it has been shoot up to 1.64% on the 12th of March. So now we can move on to the core topic that we're going to talk about today. Where is the inflation coming from and how fast it will come? First, we can categorize inflation into three major types. The first one is cost-push inflation. The second one is currency devaluation. And the third one is demand pull. Basically, there is quite a lot of things happening now simultaneously that lead to the rising inflation expectation. And to be honest, most of them will have some kind of interdependency among each other. But it will still be good to break it down and categorize it if we want to further investigate and understand the root cause of that. So let's first talk about the cost-push inflation. It was happening because there was an increase in the raw material costs and a lack of supply. And consequently, it lifted up the whole supply chain costs. As you can see from the right-hand side, there's a chart showing the GSCI commodity index. It is an index consists of 24 commodities from different sectors, including energy products, industry metals, agricultural products, oil, copper, and so forth. So you can see the index has been already rising from the March of 2020 because of the COVID-19, the breakdown of the COVID-19, leading to the shutdown of the factory, leading to the reduce in factory investment or suspending the expansion or continue of the factory operation. So the natural consequence is that there was a lack of supply. And the consequence has been brought forward because the inventory will be reduced accordingly. And then you can see the index has been stabilizing since September as the COVID-19 has been kind of stabilized. And then you can see starting from November, it started to shoot up again. And you can see from March 2021, the index has already been double from March 2020. So you can see that it is quite evidence to say that the commodity price is actually rising and rising quite fast. And naturally, it will lead to some cost push inflation to be spread across different value chain. So now, let's talk about the currency devaluation inflation. Why it is happening is because the major commodity pricing are all based on USD. USD is actually the benchmark pricing and the settlement currency for commodities trading, and therefore its values will have a direct impact in commodity price. So you can see from the right-hand side chart, the USD has been devaluated about 10% by about 10% since March 2020, from 103 to 92. So when we say that USD has been devalued by 10%, fundamentally it means that the commodity price has been raised by 10% equally. So then the next logical question to be asked is that, will the USD continue to be weakening? As you can see that there are trillions of dollars has been printed during the COVID-19 period to inject a lot of liquidity to save the market. And not to mention there are 1.9 trillion stimulus coming forward. So with these two key factors in mind, it will be hard to imagine that the USD can be strengthened a lot in the coming future. So here's come to the final type of inflation, the demand pull inflation, which is also the most critical ones. So why it is happening is because there is a development of vaccine, an end of lockdown period, and an expectation of economy recovery. It will have a very profound impact of the rising inflation expectation. Because think about that, how many purchasing power has been suppressed during the COVID-19 period because people are simply worrying about the life and death issue and have no intention to make further purchasing decision for those not essential stuff like house, car, or other luxury goods. And they are also worrying about their employment status or employment eligibility since the economy is very bad. So you can imagine when people is thinking about that with the vaccine, with the end of lockdown, the world might be able to back to normal. And therefore they will start resuming the purchasing decision, like they may start thinking of buying something. And at the same time, not to mention that there is already been trillions of liquidity injected in the market and waiting to be further utilized. So this suppressed purchasing power, when it has been fully released, it will have a very profound and a huge impact towards the inflation outcome. So we can do a very quick wrap up here. We have mentioned that there are three major types of inflation: cost push, currency devaluation, and demand pull. To a very large extent, the current rising bond yield has only been reflecting the impact of cost push and currency devaluation, and perhaps some of the demand pull inflation factors. And when the demand pull inflation factors has been fully reflected, like when the vaccine is really rolling out smoothly, when a lot of population has been taken the inflation, when there is even a higher certainty about the economy can back to normal, the demand pull inflation factors will be even higher, which has not yet been fully reflected. So you can see what the Fed chairman has been trying to do recently is that he is trying to calm down the market by reassuring that the Fed will not lift up the interest rate or pull back the liquidity earlier than the market has been expected. But then you can see that the market just got a different interpretation. As you can see, the rising 10-year bond yield has already told everything because, for one, the market simply think that the Fed has been reassuring the inflation is coming. And also, there is another credibility issue towards the Fed because the market might not trust the Fed will really do nothing or pull back when the inflation is coming. You can see the same issue is also happening in Australia and New Zealand, where the central bank is trying to comfort and reassuring the market, or even taking some real action, buying extra bond. But the yields is simply cannot be controlled and keep surging. This leads to another serious question is the capability and the credibility for the central bank to influence the short-term yield. And we might cover that in other episode if you're interested. So that's the end of the today topic. If you like the channel, please click the like button for me and subscribe the channel. See you soon.